Hey there, future financial sharpsters, and welcome back to the channel where we demystify the markets and uncover unique opportunities lurking in the shadows. Today, we're diving deep into a fascinating micro-cap stock that has absolutely lit up our hard-to-borrow screener, NVVE. We're talking extreme cost-to-borrow fees and a supply of borrowable shares so thin you could practically see through it. But before we get into the nitty-gritty, let's take care of some important business. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk NVVE. This is a microcap company, and as you might have noticed from our data, its sector is currently listed as N/A. What's truly striking about NVVE right now is its extreme liquidity. Looking at the recent price action, NVVE has seen a plus 0.0% change today, plus 0.0% over the last 5 days, and even plus 0.0% over the last 30 days. Similarly, trading volume has been incredibly low, with 0 shares traded today and a 30-day average volume of 0 shares, resulting in a relative volume of 0x average. Now, you might be wondering, how does a stock with literally no recent trading activity end up on a hard-to-borrow screener? And that's precisely why NVVE is so intriguing. Despite the silence, the underlying mechanics of short selling are screaming. What is cost to borrow and why it matters? So, what exactly is cost to borrow or CTB, and why is it such a critical indicator for potential short squeezes? Simply put, the cost to borrow fee is what a short seller has to pay, typically on an annualized basis, to borrow shares of a stock before selling them. Think of it like renting a car, you pay a daily or weekly fee to use it. For short sellers, this fee is paid to the broker who locates and lends them the shares. When a stock's cost to borrow is low, it's easy and cheap to short. But when it skyrockets, often well over 100% annualized, it tells you two things. 1. There's very high demand from short sellers who want to bet against the stock, and 2. The supply of available shares to borrow is incredibly scarce. These high fees are a direct reflection of that supply-demand imbalance in the borrowing market, not necessarily the trading market itself. Why the stock is hard to borrow right now. Now let's bring it back to NVVE and why it has earned a remarkable 69.5 on our composite squeeze score. Highlight numbers on screen. The annualized cost to borrow fee for NVVE currently stands at an astounding 774.9%. Yes, you heard that right, 774.9%. What's even more dramatic is the momentum behind this fee. It surged by an incredible plus 738 percentage points over the last 5 trading days alone. This isn't a gradual climb, it's an explosion in borrowing costs. Zoom in on shares available, and here's the kicker: there are only 300 shares currently available to borrow across the market. To put that into perspective, the estimated float for NVVE is around 7.5 million shares. A mere 300 shares available compared to a float of 7.5 million, coupled with the stratospheric borrowing fee, paints a very clear picture of just how tight the borrow market for NVVE truly is right now. Squeeze mechanics explained. So, what does all this mean in the context of a potential short squeeze? A short squeeze occurs when the price of a stock rapidly increases, forcing short sellers who bet against it to buy back shares to limit their losses. This buying pressure, known as covering, further drives up the price, creating a domino effect. When a stock like NVVE is such a high cost to borrow and virtually no shares available, any upward price movement, however small, could trigger significant stress for existing short sellers. They'd face not only escalating daily borrowing fees but also dwindling options to exit their positions without incurring even greater losses. This forced buying by short sellers can create a powerful wave of demand, propelling the stock higher. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to maintain their short positions. Dilution risk check. One critical factor to consider when evaluating any potential short squeeze candidate is dilution risk. Dilution happens when a company issues new shares, either through a secondary offering or other financing activities. This increases the total number of shares outstanding, which can depress the stock price and provide fresh liquidity for short sellers to cover their positions, thereby negating or at least dampening any short squeeze thesis, even with sky-high cost to borrow fees. For NVVE, our recent check found no recent dilutive SEC filings such as -1s, -3s, or 424B filings in the last 90 days. Additionally, we found no recent reverse split found for NVVE in the look-back window. This means that, based on recent filings, the company has not actively increased its share count, which is a positive sign for any potential squeeze scenario. Again, a quick but important reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given the current extremely low volume and zero price movement for NVVE, this is a very unique situation. The high cost to borrow and limited shares are creating a potential powder keg, but it lacks a spark right now. What we'd be watching for in a stock like NVVE is a significant uptick in trading volume. Any sustained buying pressure, even on relatively small volume, could rapidly deplete the remaining 300 borrowable shares and squeeze existing shorts. Keep an eye on any news or developments related to the company, as even micro-cap news can sometimes ignite interest. Without volume, the impressive cost to borrow is currently an indication of theoretical pressure rather than immediate market action. So there you have it. NVVE, a micro-cap stock with no recent price action or volume, yet boasting an incredible 774.9% annualized cost to borrow fee and only 300 shares available to short. It's a stark reminder that even in seemingly dormant corners of the market, the forces of supply and demand for shares can create highly unusual and potentially explosive conditions. This is a fascinating example of a stock that has all the ingredients for a significant short squeeze, but currently lacks the trading activity to ignite it. As always, do your own rigorous due diligence. If you found this deep dive into NVVE and the mechanics of hard-to-borrow stocks valuable, please hit that like button, subscribe to the channel for more unique market insights, and let us know in the comments if there are any other tickers you'd like us to put under the microscope. Until next time, stay safe out there, and happy hunting.